Hi guys and welcome back to Yashi. Today with an economy update, we have two major data points that were released yesterday and today, and these are two key measures that the Federal Reserve looks at to decide whether to increase, stabilize, or bring down interest rates on their end. So let's get right through it. So the first one is the PCE report. When it comes to inflation, there are two ways to look at it. One is the CPI report, which came in the beginning of November. It looks at the spending by consumers, just the consumers, and that's pretty much it on a year-over-year basis. The PCE, on the other hand, takes into consideration also the companies and how much they are spending. So when it comes to inflation, the Federal Reserve mostly looks at PCE. And for the second time in the past 30 days, we have another report that beats, or in this case, met the expectations of the market, which again means we're getting into a more stable environment. Stuff that is being expected is starting to happen and not bringing too many surprises, which is good news for stability and stability also among investors. So let's get to it. We have a PCE report that reported 6% increase in prices compared to last year. On the other hand, the Federal Reserve mostly looks at PCE excluding food and energy, they call it core inflation, as food and energy are too volatile and too uncontrollable from a US standpoint. Food and prices are mostly set on an international, let's say, market rather than US market. And in that case, it's 5%. Again, we met expectations, which is good news for the market. And we're also seeing, we're going to go back now with PCE, a downtrend when it comes to inflation. We peaked around June at 7% PCE, and now we're at 6% in October. Now it's not moving super strong, but we're seeing a constant drop in inflation since June, which is good news for the market. Again, we cannot sing victory immediately, but the trend is looking good. The second report that came out here is the employment situation. Now, the Federal Reserve has the job on one hand of keeping inflation down, on the other hand, keeping employment up or unemployment down. And in this case, they're focusing much more to look at inflation, as inflation is being very hard on Americans. And they're okay with crushing employment a little bit more to help inflation go down. Because if people are not making money, people will spend less, people will save more. And by saving more, spending less, companies are forced to bring down prices to incentivize people to consume again. So how is it looking with employment? Employment didn't really move. We're still at 3.6%, and employment actually still increased by 263,000 people, workers, in November. So unemployment is actually still dropping, even after the Federal Reserve went through one of the highest rate increases we saw in the history, after, of course, the one we saw 40 years ago. Now, there was a report I saw a couple of days ago, also talked about it in a few videos, that said that companies are focusing on keeping the employees it took so long for them to find the past 2 years as there was a labor shortage, and would rather incur a little bit of losses to sustain and keep these employees throughout, let's say, a bad market timing, rather than lay them off and try to hire them again. They don't want to go through the hassles they went through in the past 2 years. So we have that, and on top of this, we have still a high let's say, demand for jobs and not enough supply. There's still a lot of people that are not in the market, even though they should be in the market. We don't know why, we don't know how, but that's the situation. So from an employment standpoint, what this means for the Federal Reserve is there's still a lot of room for them to increase interest rates even more, because as long as they don't tame inflation or don't, let's say, hit employment too hard, they still have room to increase their interest rates, which is their main weapon to fight inflation. The second one is a quantitative tightening, but I won't go too much into that. So this is the situation. Now, in terms of market in general, if for the second time in the 30 days we have the market expectation being met or even beat in terms of inflation, this brings a little bit more security. So what does it mean for consumers? Let's talk, for example, about mortgages. In terms of mortgages, we saw mortgage rates coming down since the last CPI report in November. Market expectations were met. Banks are starting to, let's say, chill out a little bit more, being like, okay, we're starting to see some changes. We don't have to keep our mortgage rates so high. So this is why on average, we have been seeing since November interest rates going all the way up from 7.3 and all the way down from 6.67 where they stand today. This is bank rate, of course, depending on the website you look at, data can be a little different. In terms of Fed, on one side they have room to increase interest rates, on the other they're seeing inflation possibly, maybe starting to come down. And one thing I mentioned on my last Federal Reserve update a few days ago that you can check right here is that the Federal Reserve started mentioning that they will slow down their rate increases, and their main focus now is to understand when they should stop rather than what the next rate increase will be. So their main focus now is when to stop, when to stabilize, how long to stabilize for, and when to start dropping interest rates. They've done a really good job at increasing them very quickly in the past month, but we're starting to see the Federal Reserve being a little bit more, let's say, still cautious, but it seems like they're starting to slow down. They're becoming a little bit more optimistic. We don't want full optimism to be seen by the Fed, because if people see a very optimistic Fed, people will become euphoric and people will start flooding all the markets and starting to buy stuff, and we're gonna go through inflation again. So there's still a lot of caution by the Fed, but we're starting to have a sentiment where they're slowing down, they're starting to be a little bit more optimistic if you read between the lines. With that said, guys, this is all for now. I hope this helps you to understand what could potentially happen in the future. It seems like interest rates will start to stabilize, at least from a mortgage perspective. But of course, I am not a financial advisor. I cannot predict the future. This is simply based on what I've been seeing. But yeah, that's all for now, guys. Thank you for watching. Ciao.